Hello, ladies and gentlemen, and welcome to our webinar, sponsored today by CMS Trader, Capital Markets Trader. And today we're going to be talking about getting a handle on technical analysis. Now, CMS Trader is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you want, during class today, if you go to www.cmstrader.com and click on the buy or the sell button, you can open up a demo account almost immediately, and there's no credit card or deposit required, and you can follow along using their charts and their technical analysis and their technical indicators as I go through this in class today. So remember, go to www.cmstrader.com. There's many reasons you should trade with CMS Trader. But first of all, their guarantee of security, their impeccable service, and their advanced education for traders are just three of the most important reasons that you should try out CMS Trader. You get free daily signals, you get free market updates, you get technical analysis, all on their advanced trading platform. You also get a very wide range of trading instruments, including Forex and CFDs for stocks, commodities, and indices and cryptos. You can also use their watch, copy, and profit experience, which means you simply select one of their traders, not a CMS trader, but a trader that's trading on their platform. You can see how all their results are, what assets they trade, and decide to follow along their trades and duplicate their trades by using their social trading platform. And that's just another experience for you. And then lastly, you can learn how to become an independent trader with CMS Trader. You can watch their video tutorials for both beginners and professionals. You can attend their webinars, as well as have one-on-one sessions with financial experts, and take advantage of their extensive ebook library. Now, today's class is being recorded. If you want to see a recorded version of this class, you can use the same link you used to come to this class to see an unedited version in about 24 hours. Or in a week or so, you can go to www.investing.com and locate the education tab and then find this webinar on webinars on demand. But it's going to take a while for them to get it edited and cleaned up and up there for you. So immediately just use the same link and you can see an unedited version of today's class. So let's start talking about technical analysis. Now, learning how to get the most of the markets using technical analysis will help you trade successfully. Not everybody believes in technical analysis, and unfortunately, lots of beginning traders think that technical analysis is very complex. They don't understand there are many different sectors of technical analysis, and they intermix what we call technical indicators with technical analysis. But the basic explanation of technical analysis is anything that's done on a financial chart. Period, the end. We could call technical analysis chart analysis. Now, a couple comments before we go on with the class tonight. Number one, there is a handout. You see it on your screen and you can download it now. The only way to get this is to click that download and save it onto your computer, your laptop, your mobile, whatever you're using at the moment, because it's only available during class. Now, also today, I'm going to be popping up on your screen some poll questions. These are not complex questions, and we're not going to ask your name or any personal information. It's simply polls to help me perform better and understand what the audience that attends the webinars are looking for, or what makes, who makes up the audience, so that I can better build my webinars and build my presentation. So I'm going to pop one up right now, And so you can see what it looks like. Your screen will turn blue. And just click on the boxes that are appropriate. Again, we're not collecting any information about you as a person. Nothing's tied back to you. So let me pop one up for you now so you can see what it looks like. And just click on whatever boxes you think fit you. Like I said, there's nothing that requires your name or any personal information. Now, technical analysis is the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. In its purest form, technical analysis considers only the actual price behavior of the market or instrument, based on the premise that price reflects all relevant factors before an investor becomes aware of them through other channels. So a true technician pays no attention to news, headlines, earnings reports, statements, press releases, because they believe that all the information that is known or will be known about an asset is already been factored into the price. Now, there are three assumptions that we make when we talk about technical analysis. And I'm going to qualify these as we go through, because these assumptions were assumptions that were based on by professional traders way before we had online trading and before we had this huge retail market. Now, even though traders like you and me only make up 6% of the overall market, it's a big number. And online trading has changed our perspective on a lot of things. So the three assumptions are: history tends to repeat itself, price moves and trends, and the market discounts everything. So price moves and trends is like in the old saying, the trend is your friend. There are only three ways that price can ever move. Price can move up in an uptrend, down in a downtrend, or it can move sideways in a congestive trend. Okay, so that holds true. And the old adage that the trend is your friend will hold true forever. Now, technical analysis is widely used among traders and professionals, and some studies say it is used more widespread than fundamental analysis in the financial markets. And this is true, especially today with all us online traders and the advancement of computers and software. Because when I started trading 40 years ago, we did use some technical analysis, but because we didn't have computers and we didn't have things that would do all the calculations, most of us didn't use these things because we didn't have the ability to do the calculations fast enough to use them. Today, whether you're using the charts on CMS Trader or you're using charts from TradingView or you're a professional, you're getting the same charts, and all of these charts will drop these technical indicators immediately for you and do all the calculations. So everybody can use them and gets the information just as fast. Now, technical analysis is a methodology that makes buy and sell decisions using market statistics. It's primarily involved studying charts showing how trading history and statistics for whatever security is being analyzed. Now, the surprising part is no matter what type of technical analysis you're using, whether you're using charting, whether you're using chart patterns, you use support and resistance and trend lines, whether you're using indicators or oscillators, guess what? They're all based on 5 possible pieces of information. They're all based on price. Some use high, some use open, some use slow, some use close, some use all of them, and a lot use volume. But that's it. All of them use these 5 pieces of information. So to perform technical analysis, investors start with charts that show the price and trading volume history of a particular asset, as well as a host of other statistical measures such as moving averages, maximum minimums, and percentage change. But all of those are technical analysis. They're all formulas. The idea is to use the chart to identify trends and changes in those trends. There are several kinds of trends and patterns, some with unusual names like rectangles and triangles and head and shoulders. Then we also have indicators like Bollinger Bands and MACD. And then we have charts with like candlestick charts, Japanese candlesticks. And some technical analysts also use indicators and oscillators to interpret trading data. So the field of technical analysis is quite broad, and you can pick and choose what part you want to use and how complicated you want to make your charts or your analysis. I use basic information. I don't think a complicated system is required. I use support and resistance, trend lines, and chart patterns. That's it. Because you can make it overly complicated, but the fact is, all it's going to do is help you decide whether you want to make a trade, which direction you're going to trade, and what price you want to enter the market. There's no set of indicators and oscillators and patterns that's going to guarantee you profit. Risk management, money management, and order entry are more important than complicated strategies. And even though there's all kinds of gurus out there promising you'll get 80 to 90% return on your money and their system never fails, they're all full of BS. And the fact is, you should never be following somebody else's system. You build what you're comfortable with, you build what that fits you, and you start to learn from them, so you're making your own educated decision. So technical analysis can be as complex and as simple as you want. So I just popped up another chart, another poll. If you could just click off the appropriate answers while I talk to you, we'll keep on going. So imagine technical analysis and charting is like building a roadmap. Now I'm going to tell you a story. Back in the old days, and some of you guys have turned my webinars before, know that I'm a pretty old guy and I've been trading for over 40 years. So 40 years ago, we didn't have any type of computers to use, and we did charting by hand. And we used, when we were driving, we didn't have GPS. We used atlases and road maps. And to me, today's advanced charts look like complex road maps. Now, when I'd have to go to a meeting across town or across out of the city, I'd call on the phone and get some general directions, and I'd write it all down, and I'd always leave myself an extra half hour because I'd always get lost. So I spent half my life in filling stations asking directions. Where my business partner in those days, he could pop out the atlas out of the glove box, and he would get us wherever we were going so easily because he could read all those lines and interpret all those lines. He'd say, go to the next roundabout. As soon as you do, go to the third exit, take the third exit, we'll pass a filling station. When you pass the filling station, look for the church. When you see the church, turn left, and then go 2 blocks down past the school. And then when we pass the school, we're going to look for the entrance to the driveway, and that's where the office is we need to go. And we'd get there right on time, never get lost. So technical analysis and charting has to be what you're comfortable with. It has to be what fits your personality. But remember, even just looking at a financial chart is technical analysis. Unlike fundamental analysis, which focuses on finding a security's true value by studying financial statements, market outlooks, competition, and economic events, technical analysis is based on the belief that past market trends can predict future market behavior for the whole or an individual asset. If an investor can correctly interpret a chart's message and predict a security's movements, he or she can obviously make a lot of money. Certain aspects of technical analysis are controversial, such as the belief that markets move in trends that can play out over a long period of time, and the contention that market action can detect shifts in supply and demand. Okay, now, because regardless of what you're using, you have to start out with financial charts. So let me pop some charts up on our screen. And let's okay. And we're simply looking at, as soon as it pops up on your screen, there we go. We're looking at a gold contract. Actually, let me take you to my euro. This is my euro class chart. This is not something I set up for trading or making decisions. This is my class chart. So the first thing I'm doing is close down some of the indicators that we have down below, because I want to concentrate on the actual financial chart first. So what we're looking at is a Japanese candlestick chart for the euro US dollar in 1 hour time segments. So in other words, each one of these candles are put on the chart for each hour. Now we can select a 30-minute chart, a 15-minute chart, a 1-day chart, a 1-week chart, and each one of those candlesticks would represent the open, the high, the low, and the close for that time frame. So since this is a 1 hour chart, we would be looking at 1 hour, each candlestick denotes 1 hour of trade. So at the beginning of that hour, we would put a mark on our chart for the open. At the end of that chart, we would put a mark on our chart for the close. And then we would draw a dot for that, whatever the high point was for that period, and a dot for the low point. And then we would fill in the candle. Now today's class is not about charting. This is not a class on understanding charts. That's next week's class. This week's just a general piece of information or general introduction to technical analysis. Okay. So we're not going to go on and learn how to read the Japanese candlesticks right now and what the reds and the greens mean and what the bodies and the shapes and the size of the candles mean. All we know is that we're looking at a candlestick chart. Okay. We can easily today, because of computerized charts, flip this over to a bar chart, because there's 3 basic types of charts. We have line charts, bar charts, and candlestick charts. Now from there's a whole bunches of variations, but they fit into these 3 categories. Now a candlestick chart and a bar chart have the same exact information. They cover the open, the high, the low, and the close. The only difference is a bar chart puts a bar on it, a candlestick chart draws a candlestick. Okay. You decide which one you would like to trade with, but they're going to give you the same information. The last general general chart is a line chart. A line chart gives us very little information. We put a dot at the close of each 1 hour time segment on a 1 hour chart, connect those dots together. It just gives us a general look at how the markets are trading. So you really can't do technical analysis or make trading decisions from a line chart. So we're going to go back over to the candlestick chart, and this is the very beginnings of technical analysis, is looking at a chart and seeing what the chart is trying to tell us. Okay? That's it. And this is called price action. Price action is ultimately the most important thing that happens. But we can also see that we actually have a trend. Now, traders think, and most beginner traders think price moves in that direction, but price doesn't. Price moves up and eases up and eases up and ease up and ease. And a well-developed trend will have these peaks and valleys. They're called retracements. A well-developed trend will not look like that. Okay. So in other words, we see push and ease, push and ease, push and ease. We have a very nice, well-developed uptrend at the moment. And again, this is all part of technical analysis because it is done on a chart. I just want to get my markers off of here. Hold on a second. Okay. We can now go over to my gold chart. And on this gold chart, basically the same as a candlestick chart, it's a 1 hour chart, but we've now put on what we call levels of support and resistance. These are these yellow and red lines that I've drawn on here. And these are levels that the price has had a interesting reaction in the past. Okay. As you can see, but when gold was trading back here, it came down to this price level and kind of got stuck there. And look at all the commonality we have that at that price level. Then when we expand that forward, again, we have that here. Again, we have that here. We have all the price, for some reason, stopping and hemming and hawing at this price level. Again, we have it right here. So this becomes an important price level for gold. We have it also here. And this is when we look at history repeats itself. We can go back in history. We want to look at prices that have been strategically important, or levels that have been strategically important in the past, where gold or the asset you're looking at has had a reaction. Look at this. When gold fell all the way down to here and then started to recover, look at all those highs that touch that resistance line. They all congested here eventually. Now, it's not that it can't go through there. They are strategic points. They are information points that help you track or monitor the movement of an asset. So think of them as steps or alert zones or ranges. Now look at this, as prices moved up. Okay, if we had, let me just draw a line on here for you. If we had said that blue dotted line, which is what we looked at before, was strategically important, look at what's happened to the current price. Price shot up a couple hours ago from 1204 all the way up to 1208, and then it got stuck there. We had the open and the close right at that 1208, and the price cannot seem to gather the momentum to go above 1208. We don't know what it's going to do, but we did expect price to stop at that level. So these are standard parts of what we call technical analysis. They're not complicated. They're not complex. They don't need to scare you away. And this is the beginnings. There are, for me, the first thing I do with a chart is I put my trend lines on there, look for my support and levels of support and resistance, and I look for if a pattern is developing. That's it. RSI, stochastics, MACD, all these complex things, Bollinger Bands, standard deviation, I don't pay much attention to, because I want to be associated with price. I want to know where price is going, what its momentum is, what the volume is currently, because volume is a key piece of information. Because if you see the other traders supporting that move, because the volume's increasing, it tells you that the traders believe in that move, whether it's an up or down move. Remember, you can buy for a price to go up, or you can sell for a price to go down. We have just as much trading and profitability in downtrends as we do in uptrends. So we've talked about charts. We've talked about the different kinds of charts. We've talked about the simple lines on charts. Now we have a whole class in trend lines, because trends and trend lines are quite different. Trend is the general direction. A trend line is a rule-based piece of information. And it's very important because it's one of the few pieces of information that is rule-based. So all the traders around the world have hopefully drawn the same trend line. So then you can expect price to do something at that trend line. When it touches that trend line, to do something. Where there's no guarantee what it's going to do. But if you know that 1208 is an important number to gold because it's right on that trend line and right at a level of resistance, you're expecting something to happen. It can go through it and go up, or it can bounce off up and come down. We don't know, but we do know one piece of valuable information, that we expect something that's going to happen at 1208. And when we see what the market decides to do at 1208, we can then take some action. So let's go back to my PowerPoint. Okay, so technical analysis believes that investors en masse display much of the same behavior as investors that preceded them. Everybody wants to buy the next Microsoft, Or everybody wants to buy a stock if it gets to $50, it falls back down to $50. To the technical analyst, the human characteristic of the market might be irrational, but nonetheless they exist because investors' attitudes often repeat. Investors' actions in the marketplace often repeat in well-known patterns of price movement. Okay, and the technical analyst believes that these price movements or these patterns have predictive qualities. It's important to understand that the realm of technical analysis is not limited to just charting. It starts with charting. Technical analysis is always primarily concerned with price trends. Anything that could influence the price trend is of interest to a technical analyst. Whether technical analysis is really useful is a matter of some dispute on Wall Street. Some investors believe it's impossible to forecast the market's ups and downs. Academic studies have shown that when most people, professionals and amateurs alike, try to move money in and out of stocks to beat market fluctuations, they tend to wind up with losses. So we want to learn what information we can put on a chart. So overall, we want to identify the trend. The first step is identify the overall trend. This can be accomplished with trend lines, moving averages, and peaks and trough analysis. For example, the trend is up as long as the price remains above its upward sloping trend line. Support areas. These are areas of congestion of previous lows below the current price and marked by support levels. This is what we were talking about before, support and resistance. These are areas that something happened in the past. Now, not necessarily yesterday. The past could have been 6 months ago. You can go back as far as your charts and look for when price was trading around its current price, what happened in the past. Sometimes when you're looking at when the euro fell all the way down to 113, 106 last year, it hadn't been in that range in years and years and years. So we had to go back many years to see what was the bottom level, what price was important to because it hadn't been at that price in years. Bitcoin, when it soared to $20,000, we had no historical information. As it declined off of there, went back up, declined off of there, went. We had current short-term information. But now that it's fallen all the way back down to its low levels, we have the last year of previous trading around this range, and we can look and see what prices were important to that asset. Now, most investors tend to be either technicians or fundamental analysts. Okay, now that's not really true. Most online retail traders, like myself, tend to combine both. And I use fundamental analysis to decide where I think the assets might go, what ones would be volatile, and which ones will be trading enough to make it worthwhile for me to trade. Because remember, most of us here, we're not really day traders, but we're very short-term traders. So an asset, to buy a stock that's headed up over the next 5 years, and we buy a stock of XYZ company of 50, and we expect it to go to 65 by the end of next year. Well, if you invested for long-term growth, that was very, very good. But for trading in CFDs, it didn't help you anything. So using and knowing what's on the economics count and fundamental knowledge, fundamental news, what crazy things Donald Trump's doing, what company is attacking today, where oil inventories are, can help you make decisions. Okay, using fundamental, especially for our type of trading, because we need things that are going to have some volume and volatility. So I combine both. Because if you stop and think about it, no matter what Donald Trump does, no matter what happens in Iran with oil, no matter what the central bank does, no matter what happens with interest rates, it can help us predict whether an asset will go up or down. But not one of them is going to tell you where to enter the market. Not one of them is going to tell you where to exit the market. None of it's going to help you figure out where to put your stop loss, and none of it's going to help you calculate your risk management. That can only be done on charts. Okay. So If the Federal Reserve comes out and says, yeah, they're most likely to raise interest rates next month, well, that means the dollar should go up and gold should come down. But does that mean that I want to buy the dollar? And what price would I buy the dollar for? So by combining technical and fundamental analysis is the best way to evaluate exits and entry points. Since many people leave in technical trading rules, at the very least, these rules can become self-fulfilling, making them important to the individual investor. So think of them and your charts as a roadmap to your success. The more information you have, the more you can read these, the better you can predict. Just like when I told you about my business partner. If we saw an accident on the highway, he could look at the chart, the atlas, and say, okay, get off here at the exit, go down 3 blocks, go down, past the filling station, go to the mall, turn to the right, and then we'll be able to get back on the highway on the next exit. Okay, it just gave us more information to be more successful. So building your roadmap is like building a trading to profits. Okay, but on the other hand, you can actually have way too much information. So remember, we talked about chart types. That's very important because it's your first step. So remember, we have line charts, bar charts, and candlestick charts. But it's your choice. Forex trading and CFD trading attracts many different types of traders with many different types of systems. If you want to trade a currency pair, it's best to become as familiar as possible with it or any asset. Viewing the asset in multiple time frames is part of a process of learning its personality. Understanding the asset's personality can help you in your success with trading. One of the best reasons to learn how to read a chart is to properly apply technical analysis. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. So, doesn't this chart look just like the roadmap of London? Lots of squiggly lines going all over the place that you can't tell what it says or what it's doing. But the more information you have, the better you can read them, the more successful you're likely to be. Now, one of my favorite ways of using technical analysis, and one of the most respected uses of technical analysis and the biggest field of technical analysis is called patterns and chart patterns. These consist of things like triangles, channels, wedges, rectangles, bull pennants, bear pennants, and head and shoulders patterns. Now, triangles are one of the best pieces of information or best chart patterns for predicting market action, and some of the easiest to use. A triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking and more uncertainty about the value of the asset. With a positive sloping support line, the price levels are squeezed into a corner, and this is the crux of triangles. Price is being squeezed into a corner, an apex. As it gets farther and farther in this corner, we know it's going to be forced to break out at some given time. And they're called breakouts because they can break up or they can break down. Okay. We don't have a way of necessarily predicting the direction of the breakout, but we can sure watch for that breakout. And then there are calculations we can use that will give us the momentum of that breakout. So when we see price break out of the triangle and we see it break upward, it's telling us to trade that asset going up. And based on how deep the triangle was, we can calculate the target price. Triangles are one of the most respected ways of trading in the markets. We have ascending triangles and descending triangles. Then we also have channels and rectangles. These are also chart patterns. Let me pop up a live chart and I'll show you some. So you can see them actually developing in the real world. Okay. Here is the Australian US dollar. And here we had a beautiful triangle developing. And then price, as it moved towards the apex, finally broke out of that triangle. And look at the momentum it had when it broke out. Okay. We could have traded that breakout down, and we could have calculated where that momentum was going. Look at that. And when price bounced back, it soared back up to the trend line from the rectangle, but wasn't able to break into it. But we could have gotten a very nice down trade when it broke out of that triangle. Okay. Here we have a beautiful trend making its troughs and valleys, peaks and valleys, push up, ease back down, push up, ease back down, push up. And we were waiting for some type of confirmation for a breakout at this point, and the price broke downward. And this is a current chart, so we're still seeing it moving down. But we got the breakout, and now we would be considering making a short trade. Okay. We were considering it to bounce back up to its top of its channel, but it didn't. It broke out of its channel, and now we can calculate and do what we expect. So there's all different ways to add this into our trading, and these are just visual clues of predicting how an asset might move. So let me take you back to the PowerPoint. So we have, as I mentioned, we have channels and rectangles. We have triangles, ascending and descending triangles. We also have wedges, wedge continuations, and wedge reversals. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. Okay. However, where the support and resistance lines in a triangle have one positive and one negative slope, the support and resistance lines of a wedge would have either a positive or a negative slope. Wedges or positive slopes are called rising wedges, and the ones with negative slopes are called falling wedges. And again, this is just one sector of study that we call technical analysis. Then we have a very, very important pattern that you read about all the time in the newspaper. And it's so reliable that even the most difficult of traders use it, and that's called head and shoulders. A head and shoulders pattern is described with price movement that depicts the head and shoulders of a person. Head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts when the price graph crosses the support line upward before forming the left shoulder, and then is completed once the price graph crosses the support line downward for the formation of the right shoulder. So a head and shoulders is a very popular, very well-respected pattern. So the popular head and shoulders pattern is essentially a triple top pattern, except that instead of all peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. So it's just like a person. You have a left shoulder and a right shoulder. Some of us have tall heads, some of us have short necks, and in fact, this green line we see drawn across here is actually called the neckline. We talked about trend lines briefly, and we have a whole class on trends and trend lines. We also have a whole class on chart patterns. But trend lines are one of the most basic concepts of day trading, and they are also one of the most powerful concepts. Trend lines have been used for trading as long as there have been markets, and they are well suited for any type of market. Trend lines are based on the idea that markets move in trends, movements in one direction, then sustained movement in the opposite direction, and especially CFD and Forex markets. Trend lines show three distinct but relevant pieces of information. They help us see the strength of the move, the current price move, the speed of the move, and future support and resistance. And remember, all of this is classified as technical analysis. Now we have, like I said, we have whole classes on called The Trend is Your Friend. And we have another whole class called Trends and Trend Lines. So you can join us, but it takes, at least an hour to explain a trend and how to draw it and how to use it. All of these things we have individual classes for, except today we're just giving you some general information. So we talked about support and resistance lines. So support and resistance can be both basically explain these lines that we put on a chart. I said they're the prices where prices have hemmed and hawed in the past. So you can think of price moving in an elevator. When price is moving up in the elevator, the floor is your support, and you have to break that ceiling above your head to move up to the next floor. When price is moving down, it's just the opposite. So if you know something about the building that you're in, that the elevator's in, and what is on each floor, and where the elevator tends to stop, you can then predict where that elevator should stop on its next move. And if you draw some more conclusions about the time of day, you can then make better conclusions. So support and resistance are very, very important. And they help, and they are just one part of, again, technical analysis. And then lastly, we come to what everybody here wants to talk about. And everybody thinks it's the most important or the entire field of technical analysis, only because it's talked about the most. And these are technical indicators, oscillators and indicators. Indicators are calculations based on the price and the volume of an asset that measures such things as money flow, volatility, and momentum. Indicators, though, should be used as a secondary measure to actual price movements. These are RSI, stochastics, MACD, Williams percent R. And then there's two kinds of indicators, leading and lagging. Leading indicators precede price movement. Lagging indicators confirm price movement. So let's go back to my chart. And on this chart that we're looking at, we see oil down below the financial chart, okay, the price action chart. We see one thing, this is volume. Volume is crucially important, as I mentioned. If prices move in a direction and you're expecting to move that way, we would expect volume to be increasing and supporting that interpretation. If volume doesn't support that price movement, that means most of the traders aren't buying it. Okay. Below that, we see what's called an indicator. Now, most indicators are dropped down below price charts, although some, like Bollinger Bands, that are actually go over top of the price chart. So you see I just put Bollinger Band, and that's a band that goes above and below price. Or down below we have MACD, moving average convergence and divergence. They're all based on 5 pieces of information: the open, the high, the low, the close, and volume. They can show you when an asset's overbought or oversold, or they can generate transaction signals. They can give you divergence. Okay, they can give you overbought and oversold indicators. And there are literally hundreds and hundreds and hundreds of indicators. Actually, if I click on here, you can see on the right-hand side as it pops up on your screen. There we go. This is just the indicators available on tradingview.com. And that's just a standard range of them. But there are hundreds of indicators. Now, the oldest are the most popular because they've withstood the test of time. Like MACD, Bollinger Bands, RSI, stochastics are the most well-known of all indicators. And you can use all of them or any of them in combination or, depending on what type of trading strategy you want to have. Okay, I don't use them very often. And when I do, I use particularly MACD. But it's up to you. Some people are strictly technical indicator traders. But you have to learn the indicator and learn how to use it, learn how it reacts with the asset, and they're very reliable. Some will indicate transaction signals, buy and sell signals. Some will give you early warning of trends. Some will tell you the momentum of an asset. They give you all types of information. But everybody wants to tell me, I meet guys who learned to trade last week and they tell me, well, I'm trading with stochastics and RSI. And I say, why? It took me years to learn how to use those. Why are you trading with them now? Okay, you haven't even mastered them yet. But there are two types of indicator construction that fall into bounded ranges and those that do not. The ones that are bounded within a range are called oscillators. So when we let's look at the chart, RSI and stochastics fall in an area called oscillators. MACD and Bollinger Bands are non-bounded, are not oscillators. Now, the two main ways that indicators are used is to form buy and sell signals in technical analysis through crossovers and divergences. The second way indicators are used is through divergence, which happens when the direction of the price trend and the direction of the indicator are moving in opposite direction. Now, charts always have a story to tell, and remember this. However, from time to time, those charts may be speaking a language you do not understand, and you may need some help from an interpreter. Technical indicators are the interpreters of the Forex market. They look at price action and translate it into simple, easy to read signals can help you determine when to buy and when to sell. Technical indicators are based on mathematical equations that produce a value that is often plotted on your chart. For example, a moving average calculates the average price of a currency pair. As a currency pair moves forward, the moving average plots new points based on updated price movement it has. Ultimately, the moving average gives you a smooth indicator of which direction the currency pair is moving. So today, hopefully you got a general introduction. Now, I've given you this handout that covers everything and more, but this is only a start. Nobody can master technical analysis in a day, a week, or a month. You can take parts of it. Now, my advice to everybody is to start learning to read charts. Start with the basics of putting support and resistance lines on your chart and learn how they are, where to get them, how to master them, and learn how to put trend lines on your charts. These are the basics of building your foundations. And then learn to put volume on your charts. From there, you can decide what to do with any asset. Then you can decide if you want to use chart patterns, or you want to use indicators, and slowly master these. Slowly learn if you want to use Japanese candlesticks, learn how to read them and interpret them. But none of this is a 1 hour quick study that you should go out and waste your money. But if you spend the time and the effort, okay, it's just like, can you be a doctor and do a surgery by watching a 1 hour video? No. Well, think of the same thing when you're talking about trading in the markets. You're risking your money. Okay, those who risk it without learning, guess what? Kill the patient. Okay. If you spend a little bit of time, and think of this as a business, not as a get-rich-quick scheme, and a business takes planning, it takes operation, it takes knowledge, and you'll be able to turn your simple trading account into a successful business experience. So remember, CMS Trader offers you a wide range of trading, information, education, and knowledge. So sign up for a demo account and start using their ebooks and learning, or set up a one-on-one training class with a financial analyst who will explain and help you learn, or attend more of our webinars. And like I said, next week we'll be starting with the understanding of charts, and we'll talk 1 hour just in understanding the charts. After that, we have a 1 hour class in just Japanese candlestick charts alone. So make sure you join us and slowly learn to turn your accounts into profit. So I'd like to thank you all. And don't forget, you need to download that booklet so that you have it. And it's quite good. It'll go over everything we talked about in class in more information and give you lots of samples and guides. But again, you can get all of that help from www.cmstrader.com. And remember, you can see an unedited copy of this class by using the same link you used to come to today's class, or give investing.com a little bit of time to get it edited and up on their site under webinars on demand, but it's going to take a week or two for them to get it edited in there, and then you can see it. But you can also see all of our classes that we've ever given on investing.com by going to www.investing.com, look at the education tab, and then find webinars on demand. So thank you very much for joining us today. Thank you for supporting investing.com and CMS Trader, and best wishes out there trading in the financial markets. Bye now.